Good evening, this is your James Agee. Before we examine the structural mechanics of precious metals markets this week, I need to make something absolutely clear. I will never send you a direct message asking for money. I don't manage capital, I don't sell investment products, and I don't make price predictions to pump positions. If someone contacts you claiming to be me with an exclusive opportunity, report them immediately. This channel exists for education and community protection only, not enrichment at your expense. Now, let's talk about what actually happened in January 2025. While alarmist narratives circulated about a fictional Basel III deadline, forcing banks to hold 85% physical reserves by February 9th, the reality on the ground was far more nuanced and arguably more significant for long-term stackers who understand the difference between regulatory theater and structural market mechanics. Here is the verified data point you need to understand. In the final week of January 2025, approximately 14 million ounces of gold and 45 million ounces of silver were physically transferred from London vaults to COMEX-approved warehouses in New York. This wasn't speculation. This wasn't a Twitter rumor. This was documented bullion movement confirmed by LBMA inventory reports and COMEX warehouse data. The Bank of England officially confirmed that London gold withdrawal delays, previously processed in days, have extended to 1 to 2 months. Why? Because the metal sitting in LBMA vaults isn't all available for immediate delivery. Much of it is already encumbered, tied up in lending arrangements, collateral agreements, and swap transactions that make it functionally inaccessible despite appearing on balance sheets. This is the dislocation we need to examine, not hype about fake deadlines. The real tension between paper claims and physical availability. I want to hear from the community tonight. If you've visited a local coin shop or bullion dealer in the past 2 weeks, comment OG below and tell me your location. Are you seeing delivery delays, premium changes? I'm building a ground truth map of physical market conditions that no Bloomberg terminal can provide. Your reports help this community verify what's actually happening versus what the headlines claim. Here's what the sensationalists got wrong about Basel III. There is no global enforcement deadline on February 9th, 2026. The net stable funding ratio implementation is a jurisdiction-specific, phased process with zero coordination across major financial centers. The European Union achieved full NSFR compliance in January 2025, already in effect as we speak. The United Kingdom delayed implementation until January 2027, specifically to observe U.S. regulatory developments. The United States, after extensive industry lobbying and 4 regulatory dissents citing economic growth concerns, now faces a Basel III endgame that Federal Reserve officials indicate may not take effect until 2026-2028, with significant modifications. The UK did introduce something called interdependent precious metals permissions, allowing clearing banks to apply 0% required stable funding factors to physical stock. But this exemption applies primarily to gold market makers, not silver. London still handles over 211.8 million troy ounces of silver daily, worth approximately $3.1 billion. And that market remains exposed to funding pressure that gold does not share. So why did the bullion move from London to New York in January? Not because of a fake Monday deadline, because sophisticated entities are responding to real regulatory arbitrage opportunities, tariff uncertainty, and the mechanical reality that COMEX has been paying premiums over London spot prices, creating profitable incentives to relocate metal, regardless of what banking regulators in Basel ultimately decide. This is your James Ag. The precious metals community doesn't need fabricated countdown clocks to understand that something structural is shifting. We need verified data, patience, and the discipline to distinguish between regulatory implementation timelines and market mechanics that operate independently of compliance dates. In Section 2, I'll break down the COMEX inventory architecture, registered versus eligible, why the distinction matters for delivery capacity, and what the current 24% coverage ratio actually means versus the alarmist claims of imminent default. Stay analytical, stay skeptical, and verify everything. We're examining the institutional architecture of precious metals markets using verified data from the Silver Institute, COMEX warehouse reports, CFTC commitment of traders filings, and LBMA vault statistics. No speculation, no narrative fitting, just the mechanical reality of how physical and paper markets interact, and where the structural pressure points actually reside. As of February 2025, COMEX silver warehouses hold approximately 359.3 million ounces of silver. This breaks down into two categories that most commentators conflate, but which function entirely differently in market mechanics. 87.5 million ounces. This metal is fully available for delivery against futures contracts. It sits in COMEX-approved vaults with proper documentation and is not encumbered by private ownership claims. 271.8 million ounces. This metal meets COMEX purity standards and sits in approved vaults, but is privately owned, typically by ETFs, sovereign wealth funds, or institutional holders. It is not available for delivery unless the owner explicitly transfers it to registered status. Here's why this distinction matters for understanding delivery stress. Against this 87.5 million ounces of registered metal, COMEX silver open interest currently represents approximately 800 million ounces of paper claims. That's a coverage ratio of roughly 11-1, or about 9% if you prefer it inverted. The alarmist narrative claims this proves imminent default. The institutional reality is more nuanced. COMEX futures are cash settled by design for the vast majority of positions. The exchange does not guarantee physical delivery for every contract, nor is it required to. The coverage ratio only becomes operationally relevant during the delivery period for expiring contracts, when holders of long positions standing for delivery must be satisfied from registered inventory. However, and this is critical, the registered inventory has declined 75% from its 2020 peak of 346 million ounces. This isn't a temporary fluctuation. This is a structural drawdown that has persisted through multiple price cycles, indicating that metal is leaving the exchange ecosystem for private vaults, ETFs, or overseas markets. Under normal conditions, arbitrageurs would eliminate price divergences between London spot and COMEX futures markets. If COMEX futures trade at a premium to London, traders should buy spot metal, warehouse it in COMEX-approved facilities, and deliver against futures, capturing the spread. This mechanism is currently failing for several documented reasons. First, the London to New York premium has persisted despite the arbitrage opportunity because physical metal in London is increasingly encumbered. The Bank of England's confirmation of 1 to 2 month withdrawal delays indicates that available metal on LBMA ledgers is functionally tied up in lending chains. Second, tariff uncertainty has created regulatory risk that pure arbitrage models cannot price. The threat of precious metals tariffs disrupts the assumption that metal can move freely between jurisdictions to capture spreads. Third, NSFR implementation divergence creates funding cost asymmetries. EU banks now face stricter stable funding requirements for unallocated precious metals positions than their UK or US counterparts, altering the economics of market making across jurisdictions. The result? Price discovery is fragmenting. COMEX is becoming a regional price reference rather than a global one, while London's role as the primary spot market is constrained by inventory accessibility issues. This bifurcation benefits no one, except possibly physical holders who understand that the price increasingly represents paper market sentiment rather than physical metal availability. The latest CFTC COT report for silver shows commercial net positioning that warrants attention, not because it predicts price direction, but because it indicates institutional risk management behavior. Commercial participants, banks, producers, merchants, have maintained net short positions consistent with market-making activity, but the concentration ratios, the percentage of open interest held by the largest 4 and 8 traders, have remained elevated. This indicates that liquidity provision is concentrated among fewer entities than historically typical, increasing systemic vulnerability to positioning squeezes. Meanwhile, managed money, speculative funds, positioning has shown reduced net length compared to 2024 peaks, suggesting that speculative capital is not currently driving price extremes in either direction. For those tracking market structure, not for trading signals, but for understanding institutional behavior, current technical readings provide context. Silver has oscillated between neutral and mildly overbought territory, indicating neither extreme speculative positioning nor panic liquidation. Price action has respected the 50-day moving average as dynamic support through February, while the 200-day average continues its gradual ascent, consistent with a structural uptrend rather than parabolic advance. COMEX silver futures volume has remained elevated compared to 2023 baselines, but without the spike-to-collapse pattern characteristic of speculative blow-offs. The structural story of 2024-2025 is not about a single regulatory deadline. It's about the persistent divergence between paper market pricing and physical market reality. Consider, while COMEX silver futures have traded within established ranges, physical premiums, particularly for sovereign coins and small bars, have remained elevated above historical norms. This indicates that retail and institutional physical demand is absorbing available supply at prices above paper market settlements, effectively creating a two-tier market. The January 2025 London to New York bullion transfers, 14 million ounces gold, 45 million ounces silver, represent arbitrage activity in response to this divergence. But they also represent a reduction in London liquidity at a time when Asian markets, particularly Shanghai and MCX India, are showing sustained physical demand. The Shanghai Gold Exchange continues to trade at premiums to London during Asian hours, indicating that Chinese physical demand is absorbing metal that previously would have cycled back into London liquidity pools. Meanwhile, MCX India has implemented position limit reductions and margin increases specifically to manage volatility from speculative participation, regulatory responses to physical market tightness, not paper market excess. The data tells a clear story. We are not witnessing a scheduled regulatory crisis. We are observing a gradual, structural shift in how precious metals are priced, warehoused, and delivered. A shift characterized by inventory concentration, jurisdictional arbitrage, and the slow erosion of London's historical role as the global liquidity hub. The reframe is this: precious metals markets are transitioning from a fractional reserve, London-centered liquidity model to a physically constrained, multipolar pricing environment. This isn't happening because of a single regulatory deadline. It's happening because decades of paper market expansion have created claims that exceed the physical metal available for delivery at current prices, particularly in silver, where industrial demand competes with monetary demand for limited above-ground stocks. The NSFR rules, where implemented, don't force immediate physical backing. They alter the cost structure of maintaining large, unallocated positions. EU banks now face higher capital charges for paper metal exposure than allocated physical. This doesn't trigger forced liquidation. It changes the economics of market making, reducing liquidity in the paper markets that previously suppressed volatility. The result? Paper price suppression becomes more expensive to maintain. Not impossible, not illegal, just costlier. And when suppression becomes costlier, price discovery shifts toward physical reality. But this is where discipline matters. The structural case for precious metals as strategic assets, national security inputs, inflation hedges, portfolio insurance, is robust. The timing case is not. And conflating the two is how stackers become bag holders. Silver is not gold. Approximately 50 to 60% of silver demand is industrial: solar panels, electronics, medical applications, automotive. In a global recession scenario, this demand contracts rapidly. Solar installation rates fall. Consumer electronics purchases decline. Industrial inventory destocking accelerates. The World Silver Institute's 2025 supply-demand forecasts assume continued green energy transition spending and AI data center construction. These assumptions are vulnerable to fiscal austerity, trade war escalation, or sovereign debt crises that redirect government spending from infrastructure to debt service. A severe recession could transform silver's structural deficit into a temporary surplus, crushing prices regardless of monetary demand. Gold might maintain bid as a flight to safety asset. Silver has no such guarantee. Precious metals are priced in dollars. When the dollar strengthens, whether from safe haven flows, relative U.S. economic outperformance, or tightening financial conditions, metals face headwinds measured in fiat terms. Real yields, nominal treasury yields minus inflation expectations, present a particular risk. The current environment shows sticky inflation with elevated nominal rates, producing positive real yields that compete with zero-yield assets like physical bullion. If the Federal Reserve maintains higher for longer policy to combat inflation, the opportunity cost of holding metals increases. The bearish scenario. Dollar index breaks above 110, real yields sustain above 2%, and precious metals enter a grinding bear market lasting 18 to 24 months, while macro traders chase yield elsewhere. Remember 2011? Silver approached $50 an ounce before CME Group implemented 5 margin increases in 9 days, raising the cost of carrying futures positions by approximately 84%. The price collapsed from $48 to $34 in 2 weeks, not because physical demand evaporated, but because leveraged paper positions were forced to liquidate. This tool remains available. If silver volatility spikes, whether from speculative frenzy or genuine supply stress, exchanges can and will raise margin requirements to protect clearinghouse stability. This is not conspiracy. This is risk management that disproportionately affects long speculators. Furthermore, the CFTC maintains authority to investigate and prosecute manipulation, but also to implement position limits that constrain how rapidly prices can move. Regulatory intervention is a two-way street. It can suppress manipulation, but it can also suppress price discovery when that discovery becomes disorderly by institutional standards. Silver's industrial demand assumes continued use in photovoltaic cells, where it comprises approximately 10 to 15% of cell cost. But solar technology evolves rapidly. Perovskite cells, organic photovoltaics, and silver reduction technologies are in active development. A breakthrough that reduces or eliminates silver in solar applications would remove the single largest industrial demand pillar, approximately 100 million ounces annually, from the market. Silver's 30-day realized volatility averages approximately 25 to 30% annualized, roughly double that of gold. For leveraged traders, this volatility destroys capital, regardless of long-term directional accuracy. A 30% drawdown in silver requires a 43% recovery to break even. 2 consecutive 30% drawdowns require a 100% recovery. The bearish case for traders is simple. You can be right about the macro thesis and still lose everything through poor position sizing, leverage, or timing. The metal doesn't care about your conviction. Recession demand destruction for silver is temporary. Industrial demand recovers, while monetary demand persists. Dollar strength cycles reverse as fiscal deficits erode confidence. Margin hikes cause liquidations that create better entry points for patient capital. Technological substitution takes years or decades, not quarters. Institutional suppression faces rising costs from regulatory arbitrage and physical inventory constraints. The bearish case is not that precious metals are worthless. It is that the transition from paper to physical price discovery will be longer, more volatile, and more psychologically demanding than the bullish narrative suggests. Silver Institute data confirms a 4th consecutive annual supply deficit in 2025, 215 million ounces of demand against 200 million ounces of supply. This isn't a temporary imbalance. It's geological reality meeting industrial scaling. Lead zinc mining, silver's primary source, faces declining ore grades. Solar and AI demand is price inelastic in the short term. Above-ground stocks are being drawn down to bridge the gap. Central banks purchased 863 tons of gold in 2025, with 57% of buying unreported, suggesting strategic accumulation outside transparent channels. Poland added 102 tons. BRICS plus nations are building gold reserves while de-dollarizing trade settlement. This isn't speculation. It's documented reserve reallocation. The January 2025 London to New York bullion transfers, 14 million ounce gold, 45 million ounce silver, represent arbitrage in response to delivery stress, not regulatory deadlines. When metal moves at scale to satisfy delivery requirements, the paper market's ability to suppress prices through unlimited claim issuance faces mechanical constraints. You own insurance, not a trade. Ignore volatility. Verify storage arrangements. Maintain geographic diversification. Position sizing matters more than direction. Use volatility to accumulate, not to chase. Never risk capital you cannot lose entirely. Cost average through cycles. The structural case unfolds over years, not weeks. No single deadline drives repricing, but shifting capital costs alter market structure over time. COMEX registered inventory down 75% since 2020. London withdrawal delays extending to months. Premiums persistent. Demand inelasticity in solar, AI meets monetary bid during fiat stress. If COMEX registered silver approaches sub 50 million ounces, while open interest remains above 700 million ounces, at what point does delivery stress force exchange rule changes? Or does the market simply accept that paper settlement is the permanent norm? Verify everything I've cited. Check the COMEX warehouse reports. Read the COT data yourself. Subscribe for continued analysis that respects your intelligence. Invest with logic, not hype. This is your James Ag. Protect your wealth, protect your community, and never stop asking who benefits from the narrative you're being sold.